guys, and welcome to the 2-Minute Money Manager. I'm your host, Stacey Johnson, and this answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Let's see what we've got for a question today. It comes to us from Herb, and Herb says, I'm fully retired at age 83. I have an IRA, a Roth, and municipal bonds that generate income. Fed and state tax on the bond income kills me at tax time. Is there any investment I can make with this income to avoid the tax crunch? Well, this is a good opportunity, guys, for us to understand bonds in general and municipal bonds in particular. Now, like most retirees, Herb invests for income and also, obviously, for safety. And that typically means investing in bonds. Now, for the uninitiated, a bond is just an IOU. You loan your money to a company, a government agency, and they promise to pay it back at a specific date in the future, along with some interest along the way. Just that simple. Now, bonds come in several types, and they're all accurately labeled. You can figure out what they are just by hearing them. Corporate bonds, what do you think? They're issued by corporations. Government bonds, also known as treasury bonds, obviously issued by Uncle Sam. Municipal bonds, that's the kind that Herb's talking about. They're issued by municipalities, state or local governments. So bonds can be purchased individually as well as collectively in mutual funds and exchange-traded funds called ETFs. So you can buy a collection at once. Okay, now, while these different types of bonds work basically the same way, here's the thing. The interest they pay can get vastly different treatment when tax time rolls around. Here's what I mean. Interest on corporate bonds, it's just taxable. It's just taxable like any other income you have, both federal and state generally. Now, interest on U.S. government bonds, that's taxable at the federal level, but generally free of state income taxes. And municipal bonds, it's the opposite. Interest on municipal bonds is taxable at the state level, but it's generally federally tax-free. This is called reciprocity, for those of you who want to look this up and get into a little more in the weeds. But basically, the feds don't tax state bonds, and the states don't tax interest on federal bonds. And that's why you have this. Now, there's one more thing, though. Interest on municipal bonds that are issued in the state where you live can be completely tax-free. They can be federal, state, and even locally tax-free. Now, since municipal bonds offer income that's potentially free of federal, state, local income taxes, you might logically be thinking, well, why would I invest in anything else? Well, the answer is because they're tax-free, they often pay less interest. To illustrate, just before I started this video, I got online and I checked out Vanguard and I looked at their intermediate, high-quality municipal bond mutual fund, and it was paying about 2%. Okay, remember that. Municipal bond fund paying about 2%. Their intermediate government bond mutual fund was paying about 2.5%. And their intermediate term high-quality corporate bond fund was paying about 3%. You see how that works? So in short, while municipal bonds offer tax-free interest, there's often less of it. So it kind of balances out. In fact, depending on your tax bracket, taxable bonds can often pay more in after-tax income than the tax-exempt kind. As you can see why. With 3% interest on taxable could be better than 2% interest tax-free, right? Depending on your bracket. Okay, so municipal bonds generally pay off then only for those in the highest federal income tax brackets, currently 35%. Okay, now let's go back and look at Herb's question again, though, because he said something weird. He says he has municipal bonds that generate income. Federal and state tax on the bond income is killing him at tax time. Well, isn't this a little weird? Because we already know municipal bonds are free of federal taxes. They could even be free of state and local taxes as well. So how could they be killing Herb at tax time? Well, it could be that Herb is mistaken and doesn't realize that his income from municipal bonds is federally tax-free. But there are situations when even tax-free income can hurt you at tax time. Example, when computing your income to determine whether you're going to have to pay taxes on your Social Security, income from municipal bonds, otherwise tax-free income, is included in that computation. So even tax-free income, when it comes to being taxed on your Social Security, could throw you into a situation where you're paying taxes on part of your Social Security. Now, what should Herb do? Well, Herb's already taking advantage of another source of tax-free income that he mentioned, distributions from a Roth IRA. Since these accounts were funded with after-tax dollars, you don't pay taxes when you take money out of a Roth. Another thing he could do is donate his required minimum distribution from his IRA. It's called an RMD, and required minimum distribution. He could donate that to a charity. You could donate up to $100,000 of required minimum distributions to a charity every year, and you can avoid taxes on that required minimum distribution. It's called a qualified distribution, or QCD, qualified charitable distribution. Of course, since you're donating that money to a charity, it's money you're not able to use for yourself. So some people might think that that's kind of a weird thing to do, or it won't help you anyway. Well, there are other ways you can shelter income from taxes, but most of them involve jumping through hoops, guys. For example, deductions on rental real estate can often offset rental income and the taxes associated with it, but investing in real estate is time-consuming and it's risky. Not something I'd be doing at Herb's age. Remember, he's 83 years old. The new tax law can also shelter up to 20% of self-employment earnings, but to capture that write-off, you've obviously got to be self-employed. So that's like real estate investing, not something I hope to be doing when I'm in my 80s. And then there are some passive investments like real estate investment trust, also known as REITs, annuities, master limited partnerships. Some of these things offer some income free of tax, but that's because their regular payments from those types of investments can include return of some of your investment. It's called return of capital. And the reason it's tax-free is because it's your own money coming back to you. So that's not really qualified as tax-free income. Okay, guys, bottom line of all this, what Herb should probably do is what a lot of us do around tax time. We grit our teeth, and we pay our taxes. For most of us in common situations, there's not a lot of ways to legally avoid taxes on our income. Is that frustrating? You bet it's frustrating, especially when you read articles that say things like 60 of America's biggest companies paid no federal income tax last year. I sure paid a lot. So if you don't like stuff like that, and I certainly don't, the next time you write a check for your income taxes, why don't you take an extra minute or two and write your representatives? Okay, guys, hope that helps you, Herb. I'm going to see you all right here next time.